My guest on this particular conversation is an expert on all things cryptocurrency, Ajeet Khurana. Thank you so much for joining me today.
Thank you very much for having me.
I must thank you for joining us on the day of your birthday. Happy birthday to you. And I think it's a lovely start to this conversation, wishing you that. But let's get to the context that we're in right now, Ajeet, which is there seems to be a little bit of discomfort, at least from our central bank here in India, of the kind of proliferation, shall we say, of cryptocurrency that has come about. Is that really something that is causing these central banks to say, look, we need to have a digital currency of our own?
I think that unlike other methods of digitizing currency, such as UPI, or earlier what was loosely called net banking in the form of our NEFT RTGS, when you have a digital rupee, the asset itself is digital. It's not just the communication mechanism. It's a true peer-to-peer technology. Namely, if I send you a digital rupee, it does not have to go through the banking system or through my bank and then your bank. What this does is that while it opens an entire possibility of programmatic and digital ways of dealing with rupees, what it also does is that we are stepping into the unknown. As in, when money does not periodically keep returning to a bank, we don't know what could go wrong. So yes, there seems to be some level of discomfort.
Okay, but I'm talking about the meteoric rise of the Bitcoin and the various other cryptocurrencies out there, and some people going so far as to say, look, this is going to create an alternative to the financial system that we're living in. I'm saying in that context, is it in that context that all of these central banks are saying we need to have a currency of our own?
The interesting thing is that Bitcoin, as well as other such decentralized tokens, without any encouragement from any government, and I would go so far as to say, despite severe discouragement from various central bankers, present such a compelling technology that it has risen meteorically in price, and more importantly, in today's context, in terms of adoption. Now, just imagine if indeed there was a policy framework which was enabling this. And that is what has given the impetus to digital currency being adopted by central bankers themselves. Having said that, pretty much like nobody seems to be able to control this crazy thing called Bitcoin, soon we could have a situation where nobody will be able to control this crazy thing called the central sovereign rupee, which operates on a peer-to-peer technology using distributed blockchains.
Now, it's interesting. You talk about blockchain, and I think that is really the biggest advantage, but it could also be the biggest disadvantage, because the advantage of blockchain is that there's no possibility of anonymity, and there's a very clear trace of where money is going and who is getting that money, who is sending the money. So while you have that, on the flip side of that, Ajeet, is the problem of the volume of transactions that need to take place if there is to be a shift to CBDC. And is that really a major barrier, because we're talking about blockchain technology? Can it really expand to that level?
All of the digital assets that are today transacted on the blockchain, and now I'm including Bitcoin and the thousands of other cryptocurrencies and the non-fungible tokens and all of them put together, in terms of volume of transaction, are a very negligible fraction of the total transactions that take place in the fiat currency economy. So yes, you have identified one of the biggest technological challenges, but there are solutions, scaling solutions to make blockchain operate at scale, so that a stock exchange could run on a blockchain or a foreign exchange market could run on a blockchain. And now with CBDC's monetary policy of the country could be distributed via blockchain, there are fundamentally two approaches to take in scaling a blockchain based and architecture. If you like, I could explain the two of you to you.
Please do, please do.
Okay, the fundamental reason to have democratic and empowering technologies like digital assets is that people can become their own bankers in a very limited sense of the term. So for instance, large corporations, and one example that comes to mind is maybe a coffee shop like Starbucks, would say, you know what, all of our outlets put together, we will have our own separate blockchain. In technical terms, this would be called a side chain, where we will settle all money that is going in and out of our system across all our outlets, and periodically come to the central banker's blockchain, which would be running the CBDC, and write on it, which means explain how much money we have taken away or added to it. This would be a side chain technology wherein everybody can effectively be running their own tiny microcosms of the monetary system and then interact with the central system. The other thing could be for people who are, let us say, not as evolved as, being able to run their own blockchain. This would be called level 2 technologies. One interesting analogy of this would be the Lightning Network as it serves with the Bitcoin network, wherein you don't run your own little blockchain of for yourself, but you collate a lot of transactions and then go and write one entry onto the blockchain instead of all 1,000 pluses and minuses that together constitute that one entry. If today's technology allows for side chains and layer 2s to be an effective scaling solution on a distributed blockchain.
So would you then, in that sense, in the two examples that you've given me, require or does that need intermediaries in that system?
Intermediaries in the sense of commercial banks, scheduled banks, would not be required. In fact, that would be a huge contribution of disintermediation in the need of distributing currency. But at the same time, by its very nature, a robust blockchain network requires nodes. You could loosely call them authenticating nodes or verification nodes. So you would need several locations separated physically, air-gapped, which are separately running the blockchain. I will just loosely give it a name. Let's call it the India chain. So an India chain could be created by the Reserve Bank of India, and everybody who has to take away or add digital assets to it, such as withdraw, like say, think of it as the largest ATM in the world because it has the whole country's money in it. So we could have various nodes run by Reserve Bank or by specialist agencies who are running the blockchain software.
Now, the reason I asked about intermediaries, and I'm glad that you pointed out disintermediation, that's one of the biggest criticisms and possibly one of the biggest lacunae that could emerge from the adoption of a CBDC, where you have, like I said, a tectonic shift that could emerge in the financial system, where you say that banks are no longer needed. You don't need to park your money, say, in a current account or a savings account. You can hold it directly in CBDC. So you no longer have the need for banks as transmitters in the monetary policy transmission system, right?
That is correct. In fact, if we were to not view the purpose of the banking system to be an investment vehicle, but more as a custodian of our money as well as helping us transmit it, you could actually bypass that completely when it comes to a digital rupee. I would personally not necessarily see that as a problem. It could be a problem for banks, but as far as our monetary system is concerned, removing one or two layers out of the implementation and distribution of our monetary policy, I think is a great welcome step.
Well, on that note, it's been an absolute pleasure. Let's see if our future actually changes dramatically with the introduction of a CBDC, if it actually comes to pass. It's been a pleasure speaking to you. Wish you a happy birthday once again, and thanks so much for joining us, Ajeet.
Thank you very much.